Assalamu alaikum. I'm Syed Ali, and we're back with yet another video. Perhaps the most important video in my series, because here we lay the foundation upon which we shall develop our arsenal for valuation, stock selection, and making better investment decisions overall. And I believe that this topic today is the essence of finance, the risk that you are willing to take and how you're compensated for that risk. We've all heard the statement higher the risk, higher the return. But the question then arises, how do we quantify both values? How do we measure risk? How do we measure return? And that is what we're going to answer in today's video. Starting with the simpler part of the sentence, how do we calculate returns? Now imagine you buy a stock today for rupees 100, you hold it for a year, and you get 120 rupees for the sale of it after a year. During the year, you also get 5 rupees as a dividend. Now, what will your return be? You add 5 plus the capital gains, which will be the selling price minus the purchase price divided by the price you purchased it at. In our case, that would be 120 minus 100 divided by 100. You get a return of 25%. Now, this was the easy part. Moving on to risk. What is risk? Conventionally, in finance, we describe risk as the variability of returns. But what exactly does that statement entail? That basically means that if you have an asset, in 1 year it gives you a return of 15%, the next it gives you a return of 10%, the third year you get a return of negative 5%. Each year we're seeing that our return isn't consistent. And that essentially is what risk is, how much our returns vary over the course of time. The most widely used way of measuring risk in finance currently is the standard deviation. And I know what you're thinking. What is this? I want to hold the finance community accountable for their gross use of Greek letters and just making finance so complicated. Today, we will try to simplify this equation. And trust me, when you break it down into words, it becomes very easy. Let's try to get rid of all of the Greek letters and go back to English. If you start reading the equation from left to right, you'll see this O with a line poking out. In Greek, we call this sigma, and sigma is used to represent standard deviation. Now there's the equal sign followed by an under root. The next complicated figure is the n and the rotated m. This is nothing but a fancy way of saying that add up all the values. For example, if you have 10 observations, to add up the observations from 1 to 10. N is basically a representation of the upper bound of your values. Now, we need to add up. But what do we need to add up? That brings us to the bracket. This xi, x subscript I, is basically each individual data point. So x1 would be the first observation, x2 would be the second, x3 the third, and so on and so forth. Now for each of these observations, what we need to do is see their distance from the mean or the average, which brings us to the third symbol, which is mu. You might think that this is quite familiar because it looks like the uTorrent symbol, and that's true. So this mu basically is a representation of the average. So we subtract from each observation the average and then square it. And then we add up all those values. And then finally we divide them by n. N again is the upper bound of your sample size. So for example, if you have 10 observations, n would be 10. If you have 30 observations, n would be 30. Again, this is just to explain the formula to you and make it easy to understand and just remove all of the unnecessary Greek. We will go on to develop a more intuitive understanding of what this really means. So, to develop an understanding of standard deviation, we will look at an example where we won't start with returns, we will start with heights, and we'll only use two data points. So we have the heights of two individuals, Ahmed and Essen. Ahmed's height is 200 centimeters, Essen's height is 180 centimeter. Now, their average height is 190 centimeters, right? We want to essentially capture the standard deviation, which is again, we want to see that how much does the height fluctuate from our average. And the reason behind doing that is, well, in finance particularly, is that the average return is our best guess for the future return. I want to draw your attention to this graph. The orange line basically represents the average or the mean, which is 190 centimeters. Now, these blue dots represent each of their heights, 200 and 180. So, to start our journey in calculating the standard deviation, to basically gauge the fluctuation in height, we want to get the distance of each individual's height from the mean. So 200 minus 190 and 180 minus 190. This distance that you can see, which is represented by the arrows, this is basically the fluctuation. Now, the greater this fluctuation is, the higher the standard deviation. The next step in the formula is x minus the average, which again is basically just telling us how far each point is from the mean. We get 10 when we subtract 190 from 200, and we get negative 10 when we subtract 190 from 180. The next step then is to add these so that we can get our average value. But what happens is, when we add both of these values, we get a zero, which is why in the calculation of the standard deviation, there is an additional step. Once you get the distance of each value from the mean, you then square that value so that when you eventually go on to sum them, you don't get a zero value. And the reason this happens is that the mean will always be between your highest value, which in our case is 200, and the lowest value, which is 180. So some distances from the mean will be negative and some will be positive. This holds for an example of 2 data points and will also hold for an example of 1,000 data points. So when you will add up the distances, you will eventually get zero. And to deal with this, you simply take the square. Now the fourth step is to add up the squares of the distances from the mean. We do that and we get 200. Now this is the sum of squared deviations, and this represents the total deviation of our sample, which is 2 data points. The fifth step is to take the average essentially and divide the number we got in step 4, 200, by the number of data points, which is 2. Once we do that, we get 100. And this 100 value is what we call variance. Now, there is a problem with variance. Remember, in step 3, we took the square of each distance. So we essentially multiplied 10 centimeter by 10 centimeter, which got us 100 centimeter square. Do you see the problem? Centimeter square is basically a unit for area, not height. And though you can compare variance of two different samples. For example, our sample has a variance of 100 centimeters square. If there was another sample which had two data points and its variance was, let's say, 200 centimeters square, so we could say that the second sample with the variance of 200 centimeters square has more deviation from the mean. However, it's not the most intuitive or it's not the most practical of measures, which is why to bring it back to centimeter so that we can compare it with our height, which is also in centimeter, we take the square root of of this value. This ends up being 10. 10 centimeter is your standard deviation. Now, what does this mean? If there is still any confusion, this basically tells us that our mean is 190, and it is possible that our height can be one standard deviation above 190, which is 190 plus 10, that would be 200, which is mth's height, or 190 minus 10, which is Sn's height. Now we move on to our example, which is based on stocks. We have a stock, and for that stock, we have 6 years worth of returns. In the first year, we got 14, in the second, 20, in the third year, negative 15. And now we want to see how much do our returns vary from the mean. The reason why we do this is because the mean is basically our expectation of how the stock will perform in the future. So, for example, year 7, we want to know how the stock will do in year 7. That's a question mark. So we take the mean of the historic returns, and 8.67 is what we get. 8.67 then becomes our best estimate of how the stock may perform in the future. But does that necessarily mean that we will get 8.67%? Like we saw in our previous example, no, that is not the case. And that is why we have the standard deviation. The standard deviation in this case is 12.35%, which means that it is possible that the next year the stock will give us a return of 21.02% or negative 3.68%. I'm not going into how likely it is that we will get above the mean return or below the mean return. Just understand this for now, that it is possible that your expected return can vary by the value of the standard deviation. So you may expect 8.7, but you may also get 21.02 or negative 3.68%. So when we were talking about height, our unit was centimeter. When we talk about returns, our unit is percentage. Now this usually confuses people, but all you need to know is that the percentage is just a unit. So just like for height, you had 14 centimeter for stock returns, you have 14%. Percent basically means that for every 100 rupees, you earn 14 rupees. In year 2, for 100 rupees, you earn 20 rupees. And in year 3, for 100 rupees, you lose 15 rupees. That is all percentage is. It is simply a unit and nothing to worry about. Just like when we were calculating the standard deviation of heights, in step 5, we got an answer which was in centimeter squares. Here, our answer will be in percentage square, which doesn't really make sense. And that is why in step 6, we take the under root of the value and we get 12.35%. And this is something that we can work with. I hope you found the video helpful and see you next time.